Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's May 5th, 2013. Markets rose again last week as both the S&P 500 and the Dow Jones crossed big round numbers, 1,600 on the S&P and 15,000 for the Dow. But don't worry, I'm not going to play any horns or cheering crowd sound effects. Not my style. Some of the things I talked about last week did come to pass, such as the European Central Bank rate cut, and a Fed meeting that not only backed off talk about tightening before the end of the year, but even allowed that it could do more than it's doing already, especially after a couple more economic reports were on the disappointing side. It was a similar situation over in the EU, where the latest batch of weak data closed the deal on the 25 basis point rate cut and left its president saying his bank could do more. Thank God for central banks. The euro immediately fell in sympathy, but then rallied on Friday when the jobs report came out. If that doesn't seem to make any sense, it's because it really doesn't. But the dollar trade lately has been a safety trade. So when risk is back on, people sell the dollar and bonds and buy stocks and commodities. So for example, even though inventories of oil are at all-time record levels, gasoline demand is down from last year, oil prices rose anyway on Friday on the risk-on trade, with a little short covering thrown in. So the million-dollar question is, where does the market go now? If you looked at the headlines over the weekend, they probably talked about the great jobs report on Friday. The irony is that the report really wasn't a good report. It was just a little bit better than the consensus, and more importantly, not another lemon like the March report, which the market had come to fear after the private sector ADP payrolls report on Wednesday had been a big disappointment. The two most important things about the job report are that one, jobs growth is still slower this year than last. It really is. The other most important thing, of course, is the market perception of the report. When it does sink in that jobs growth is slower, or at least the notion that all is well fades, could be relatively soon, perhaps starting by the end of this week. Although there's practically no news on tap this week in the US, and that would usually favor a continuation of last week's price action, in this case being up. So another percent or so higher isn't out of the question. Even so, some things are against the market. One is that the prices are overextended and need some kind of breather soon. Another is that once the Dow manages to close above 15,000, as it wasn't able to do on Friday, the market has lost a couple of powerful targets, 15,000 on the Dow, 1,600 on the S&P. So a lot of trading money will be looking to cash out now. A third is that the economy really is slowing. And with artificial trading programs ready to slip back into defensive mode, news that might have been dismissed in March suddenly becomes important again. The market has had quite a good run so far this year, more than is justified by either growth or earnings. So I expect a correction sometime over the next 2 months. It probably won't look like one at the beginning, and it will probably end just as it looks like the bottom is getting ready to fall out. I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.